cash ratios. How much cash do you have to pay off your debt? So this tell you how stable, how strong your firm. So how it tells you how much default risk does firm have. Conversely, the financial risk ratios tell you about the earnings volatility, for example. So by using that, there is a leverage. So in case of economic downturns, your earnings are more likely to decrease in a greater degree. So there is more probability or more risk of default. So solvency ratios and risk ratios are almost the same, but it tell you a different story. So let's look at in a moment. Okay, so simply the business and financial risk tell you about the firm's earnings volatility, and of course it is also related with the default risk, but whereas liquidity ratio tell you about the current ability, the risk ratios tell you about the future possibility. Okay, and first the growth. Okay, how much firm is growing. Okay, current liabilities are those with remaining maturities less than a year. Okay, so current assets are those that can be converted into cash within a year, and current liabilities are those that remaining maturities are less than a year. Okay, and one of the ratio that measures the internal liquidity, a solvency, is the current ratio. Okay, and current ratio indicate the ability to meet future financial obligations. So how much current assets do you have relative to the current liability? This is the current ratio. Okay, so current assets are cash plus all other assets that can be converted into cash within a year, such as cash and cash equivalents and marketable securities, and some non-fixed assets, any assets that can be converted into cash within a year, such as receivables and so on. And current liabilities are short-term financial obligations. So how much cash do you have relative to your short-term liability, short-term debt? Okay, this current ratio tell you the firm's solvency, liquidity. Okay, so greater the ratio, there is more likely the firm has more liquidity, a more strong relative to its debt. Okay, quick ratio more conservatively assess firm's ability to meet its obligations, while current assets include cash, cash equivalents, accounts receivable, stock inventory, marketable securities, or prepaid liabilities and other liquid assets. A quick ratio adjusts current assets by removing less liquid assets such as inventories. So quick assets only considers that are more likely to be converted into cash. Okay, current assets include such as inventories. The quick ratio measures the firm's ability to meet its debt obligations more conservatively by removing those less cash-like assets. Okay. Of course, inventories are current assets that can be converted into cash within a year. A quick ratio more considers a quick assets. So quick ratio measures how quick you can convert your assets into cash in case of a financial distress or to meet your financial debt obligations. Okay, so of course, greater the quick ratio, the more ability you can meet the debt obligations. And the cash ratio is the most conservative liquidity ratio. It only considers a cash. Okay, and denominators are all the same: current liabilities, short-term obligations. Okay, so it's kind of a safety indicators. Denominators only consider a current liabilities, because the current liabilities are those with debt maturities less than a year. So within a year, let's say in this year, how much probability you can meet as obligations. So it tells you about the safety. Okay. Okay, and operating performance ratios measures how well management is operating a business. So how much profitable or how much efficient. Okay, and operating efficiency ratios examine how the management uses its assets and capital, measured in terms of sales generated by asset or capital categories. Okay, the more dollar sales you generated by using a unit of asset, it means that you're operating more efficiently. And the profitability ratios analyze profits as a percentage of sales and as a percentage of the assets and capital employed, so such as profit margins. Okay, receivable turnover ratio examines the quality of accounts receivable. Okay, so receivable turnover ratios is the net annual sales divided by its average receivables within a specific period. Okay, the account receivable turnover ratio measures the number of times the company collects its average accounts receivable balance. Okay, it is a qualification of a company's effectiveness in collecting outstanding balance from clients and managing its line of credit process.